Hello everyone. Today, we are going to talk about the unseen, unspoken, but completely different face of financial markets where billions of dollars are managed, the quantitative investing universe. Think of the classic trader profile in the minds of most of us. You picture someone sitting in front of a screen for hours, drawing countless lines on charts, looking for support and resistance points, trying to read the future from candlestick patterns or complex geometric structures, right? Today, we are entering that fascinating universe, far from this classic profile, which operates entirely with mathematics, statistics, and systematic data analysis. When we want to understand this universe and modern quantitative investing, one of the most profound and striking figures we encounter is undoubtedly Cliff Asness. As the founder, managing partner, and chief investment officer of AQR Capital Management, managing billions of dollars in funds today, Asness looks at the market neither through the eyes of a completely romantic trader, nor like a rigid academic who accepts the market as 100% perfect and unbeatable. His view of the market is completely outside traditional visual technical analysis tools like trend lines, support and resistance levels, chart patterns, candlestick structures, or popularly known fair value gaps and order blocks. Focusing on the long-term statistical behavior of prices and fundamental data rather than the shapes he sees on charts, the equivalent of technical analysis for Asness consists of momentum, relative strength, value spread, risk premium, behavioral errors, and massive data tests spanning centuries. In other words, Cliff Asness is a system investor who tries to read the market not by drawing lines on a chart, but by systematically measuring price, value, momentum, and human error. So, what is this momentum? The most important value Asness assigns to price action emerges on this momentum side, to which he himself has made massive contributions in the financial literature. In his world, momentum is not a simple and emotional copycat mechanism like blindly buying an asset whose price is rising without looking back. Momentum is based on the statistical probability that assets that have shown strong performance in the past 6 to 12 months, especially compared to other assets, will tend to maintain this strength for a while longer. A very interesting detail stands out when measuring momentum in his financial models. He usually excludes the most recent month of data from the analysis. The reason for this is actually quite simple. It is to prevent short-term microstructures, instantaneous liquidity shocks, and market noise from distorting the measurement, meaning to avoid short-term reactivity. This approach is a medium-term statistical price behavior, rather than the short-term trading signals we know and look for on daily charts. At this exact point, a very critical distinction must be underlined. Many people assume momentum and trend following are the same thing. However, Asness positions momentum and trend following as two concepts that are very close to each other, but definitely not the same. Why? Because momentum measures the past performance of assets relative to each other, meaning their relative strength. It compares Amit's speed with Mehmet's speed. Trend following, on the other hand, mostly tracks the absolute price direction of an asset, its own moving averages or price channels. In Asness's world, momentum is not jumping onto a rising asset with a populist approach. It is the systematic selection of strong assets among different asset classes or stocks, the elimination of weak ones, or evaluating them on the short side. Therefore, his approach is a completely measurable and smooth mathematical momentum analysis rather than a visual chart reading process. To understand the roots of this philosophy, where this data obsession comes from, we need to look at Cliff Asness's academic background at the University of Chicago, at those challenging days. There, he has the privilege of being both a student and an assistant to Eugene Fama, the father of the efficient market hypothesis and one of the greatest theorists of modern finance. The interesting and courageous part of the matter is that, while Asness was raised in this academic environment, which is the fortress of the completely rational and perfect market idea, he chooses the momentum concept, which directly challenges and even contradicts the efficient market theory, as the main part of his doctoral dissertation. In his own narratives, he smiles as he recounts that telling his professor Fama that momentum works in real markets and that prices are not always rational as supposed required great academic courage. However, the guiding answer Fama gave him that day summarizes Asness's entire career logic and system development ethics. If it's in the data, write the paper. This principle is the foundation of the philosophy of believing not in beliefs, but in data, not in stories, but in proof, not in abstract theories, but in real market behaviors tested by theory. After completing his academic research, Asness, who began managing real money at Goldman Sachs, personally experiences how theoretical ideas face harsh realities such as transaction costs, liquidity constraints, and investor psychology. This experience allows him to use research not just to write a fancy paper, but to build systems that can survive the stressful and bloody periods of the real world. This balanced and cold-blooded stance in his view of the market separates him from many market players. Asness does not see the market as a completely inefficient area that is constantly manipulated or can be easily defeated around every corner. On the contrary, he accepts that the market is a very powerful mechanism that processes information extremely quickly, keeps active managers under massive pressure, and makes it difficult to beat indices. So, he does not worship the market, but he has tremendous respect for it. He takes the efficient market hypothesis, which argues that prices largely reflect all available information, seriously, but he does not claim that prices are perfect and reasonable at every moment, every second. This is exactly where he positions himself in his famous works. Markets are not perfectly efficient, but market efficiency should always be the safest and most disciplined starting point when designing an investment system. If you have very strong and long-term historical data sets that prove otherwise, only then can you think about getting a step ahead of the market. This situation is actually a shocking lesson for two groups of traders on opposite extremes. Those who view the market as entirely consisting of manipulation and look down on systems, or those who believe the market knows everything perfectly and think there are no opportunities. Asness rejects both of these extremes. According to him, it is a fact that human behaviors, emotional reactions of crowds, and institutional constraints leave indelible marks on prices in the market. Crowds sometimes pay excessive amounts of money for popular and expensive stories, abandon boring but cheap values, create extreme euphoria by magnifying good news, and cause panic selling by over-penalizing bad news. The quantitative system approach, then, is nothing more than the art of catching these human and structural errors with mathematical data. Let's come to that greatest strategic move that brought Cliff Asness global success. This move is his combination of two massive factors generally seen as eternal rivals in the financial world: value and momentum, under the same roof as complementary elements. Classic value investing looks for assets that are cheap, whose balance sheets are strong but ignored by the market. Momentum, on the other hand, follows strong and enthusiastic assets whose direction is upward and demanded by the market. According to the traditional perspective, these two approaches seem completely opposite to each other, because one buys the cheap asset that has fallen or remained flat, while the other selects the one that is already rising. However, in Asness's mathematical models, these two factors create a perfect balance mechanism when brought together. Sometimes a cheap asset can continue to stay cheap for a very long time due to structural problems or market indifference, and this is exactly where momentum acts as a filter, allowing us to understand when that asset wakes up from its slumber and comes alive. On the other hand, an asset that skyrockets by taking momentum behind it can become unreasonably expensive through extreme euphoria and speculation. The value factor steps in at this exact stage to provide risk management and prevent the system from getting caught up in extreme enthusiasm. Asness proves in his academic papers that momentum is not a temporary, small, or random market fluctuation, but on the contrary, a deeply rooted anomaly that works consistently in historical data spanning more than 2 centuries in American stock markets, in different countries, and across a wide variety of asset classes, from commodities to currencies. However, he has a warning. Momentum is not a holy grail on its own. It shows its most devastating and powerful performance when combined with other negatively correlated factors like value. In historical simulations, it is clearly seen how much the largest capital erosions experienced when focusing only on the value factor, or the massive drops encountered when relying only on momentum, are radically softened when a balanced combination of these two factors is used. This data is the most concrete, most mathematical proof that a system trader should not blindly bind themselves to a single indicator or a single signal, but should use reasonable system components that balance each other together. Returning to the present day, with the digitalization of financial markets, the integration of artificial intelligence, and the dizzying speed of technology, information now spreads across the world in seconds. Anyone can trade in global markets with a single touch from their smartphones. At first glance, this situation is expected to make markets much more efficient and error-free, right? However, Cliff Asness makes one of the most important financial observations of modern times at this point. The speed at which information enters prices and the accuracy of that price are absolutely not the same thing. The echo chambers of social media, instantaneous news feeds, the 24-hour continuous trading culture, and the gamified structure of trading processes have not reduced the effects of human psychology on the market. On the contrary, they have made them larger and more aggressive. Asness argues that, especially over the last 30 years, markets may have become less efficient, meaning more erroneous in some areas of the relative pricing of stocks and assets. Technological speed causes crowds to run after the same story with the same enthusiasm at the same time. This pushes what is expensive to be even more expensive beyond the limits of logic and drives cheap and disgraced values into an unfairly deeper abandonment. This situation is a vital perspective for those of us trying to understand market mechanics. No matter how much technology accelerates the market, human psychology, the fundamental dynamic that moves the price, and its systematic errors never disappear. They only change skin and give faster reactions. The solution to surviving in this new market structure is not running after short-term excitements, social media speculations, or instant price fluctuations, but staying loyal to a systematic investment process based on disciplined, cold-blooded, and long-term statistical evidence. One of the most shocking realities that system developers and those interested in technical analysis must face is the nature of historical tests, namely backtest studies and their relationship with real-life performance. Most of us fall into the illusion of assuming that when we find an indicator combination or an algorithm that gives excellent results on historical data and draws a perfect profit chart, the same results will be copied identically in the future. Cliff Asness presents a very clear and realistic investment ethic in this regard. He never sees historical tests as a promise for the future or an absolute guarantee. He accepts them only as maps that allow us to understand probability boundaries and market logic. In real market conditions, due to transaction costs, liquidity slippages, and changing market regimes, he openly argues that obtaining even half of a backtest performance is an excellent result. The success of a system cannot be measured solely by how much money it makes in theory. True success is hidden in the periods of poor performance that the system will inevitably experience, namely capital erosion or technically drawdown processes. Even the strongest mathematical models that yield the most profit in the long run can produce consecutive losses by failing to adapt to market conditions for months or even sometimes years. The fact that a strategy is theoretically correct and logical does not mean that it will make uninterrupted money every month or every year. Many investors and traders panic and abandon the strategy in the first few months when the performance of a system deteriorates and enters a drawdown period, searching for another magic formula. Yet, the greatest reality of the financial sector and professional fund management is patience and the capacity to philosophically endure these challenging periods. If you do not deeply know the economic logic behind the system you use, or why price movement is rationalized by that indicator or that mathematical model, you will lose your faith at the first difficult bend and throw your system into the trash. However, if you trust the logic, test quality, and long-term statistical advantage of your system, you will rationally question and update your model during those bad periods if necessary, but you will never change your route with panic and emotional decisions. To sum up in conclusion, the clearest, most refined lesson we can draw from Cliff Asness's life, academic studies, and the massive quantitative system philosophy he established is this: achieving permanent and sustainable success in financial markets is not about finding a secret indicator, a hidden chart formation that nobody knows, or a perfect signal whose every prediction comes true. The market is a rival too sophisticated, dynamic, and challenging to be defeated with a single holy signal. A true system investor must always approach the market with deep respect, far from arrogance. Those who can melt the momentum information of price action, fundamental value multiples of assets, institutional mechanisms, and systematic errors of human psychology in a single analytical pot survive in the long run. From the perspective of technical analysis and system design, a signal or a rule set has no magical value on its own. A trade idea is valuable only if it contains a logical economic or behavioral explanation behind it, if it has been tested and verified under different market conditions spanning centuries, if the magnitude and duration of the bad periods it will experience are accepted from the beginning, and most importantly, if it is within the risk boundaries that the investor can psychologically carry. salary, staying permanent in the market and growing capital is possible not by having the brightest or most popular idea, but by having the unwavering discipline to hold onto a rational, tested, and logical idea even in the most difficult times without compromising. Thank you for listening. See you in the next episode.